Chan, and I'm here to present a portfolio recommendation for your money. Obviously, you're here because you have a substantial amount of money and you want to invest in and have it grow rather than having it sit in the banks. Obviously, with all the headlines going on with the markets today, there's fear of, am I going to lose it if I invest it? Am I going to lose my money? But that's why hedge funds were initially created. They're created to preserve your capital and protect you from risk in down markets. Initially, they would short against your positions when they saw the market was going down. However, today, hedge funds have kind of taken on completely different strategies and shape. They've become more like a large mutual fund with more flexibility, obviously, and they also include strategies ranging from those that relate with the market movements as well as those that are totally unrelated or a mixture of both. Obviously, there's a lot of directions we could go, but that's where we come in as well. In looking at past successful hedge fund portfolios, the key to success was either they had a great management team with expert experience, or on the other hand, they just picked the right strategy for the right timing. The latter is what I want to focus more on and support it with the next two slides. Going on to the next slide, in thinking about the market, obviously we mentioned before it's been up and down, the volatility. You hear different headlines, the market goes down. You get some new announcements of plans to fix the euro crisis issues and cut the deficit in the U.S. Different headlines that help cause this market to just not stay as stable as we would like it at times. However, this can pose different opportunities with certain strategies in the hedge fund indexes that I will propose. Another thing with the market outlook is they've proposed GDP growth from major banks including JPMorgan and Goldman Sachs range as low as 2%, which is still growing, and at best case scenario 3.9%. So there's obviously still growth in the market and opportunities that could present itself in investing in the market. In thinking about that, we did an efficient frontier, which is based more on the historical returns and data, and it proposed a recommended allocation, which was very overweight in macro and relative value strategies. That is where I also agreed. However, having 58+% in relative value strategy can be kind of scary when you're thinking, we put 60% of your money in one specific strategy and over 75% total in two strategies alone. I wouldn't be so confident in that investor and that manager, and I would totally understand that from your point of view. However, I do recognize that there are opportunities with so many events coming up, as well as there's the elections that will be coming up with the potential of policy changes regarding the economy within the United States, and just many different events that pose opportunities within the macro strategy. So below the efficient frontier recommended allocations, there's also my firm's recommended allocation, where we have 30% in macro strategies as well as 30% in relative value. The reason being keeping both of those is because they're indirectly related to the market, and as there's this high volatility due to all these headlines, we can still take advantage of the mispricings of securities, of companies, and other bonds and events that we can anticipate and act accordingly to that. And that's why we have 60% of the portfolio in those weights. But at the same time, we do have a substantial weight in event-driven strategies due to its nature of also not being related to the market movements, with keeping in mind all the new laws and regulations that have limited the requirements that banks can lend to businesses. Tells us that there could, and we expect, more and more companies that have distressed assets looking for funds and money to help them out, knowing that the banks now require a higher requirement in order to allow that loan to be made. Hence, I have 25% of our portfolio in the event-driven strategy as well. But keeping in mind, like I said, there is still growth in the market, so I do have 5% each in the remaining 3 strategies of equity-focused hedge fund index, as well as the weighted composite and the fund of funds, which are more directly related with the market, and will give you opportunity, if it does go up, that you can capture gains in that. Going into the next slide kind of goes over some of the comparative analysis of certain statistics that show why this portfolio will perform to a liking that will allow you to not have to worry when the markets are down, but at the same time you'll be able to capture gains in up markets, and just a portfolio where you'll be able to go to sleep at night and still make money, which is why you are here. And looking at it, the Sharpe ratio, or not, I apologize, the annualized return of the portfolio for the past 20 years compared to the S&P is nearly double. As you can see in the numbers, there's 11.59% for the portfolio and 5.5% for the S&P 500, which is substantial in the long-term perspective. At the same time, if you look at the next number, the volatility, more of the risk involved, there's less movement, about a third less movement in the portfolio in comparison to the S&P 500. And looking at the chart to the right, you can see when there are down markets that the portfolio actually on average only loses 1.68%, which is something that I see will keep you worry-free. All in all, as you look at the other chart, it won't gain as much, but it's a portfolio that I know that will protect you in preserving your capital, as well as allowing it to gain when the markets are up. Do you have any questions? Thank you for your time.